Let's address the unspoken, overwhelming reality of divorce. While the emotional pain is front and center, it's often the financial turmoil that causes the most long-lasting damage. The process of untangling a shared life is, at its core, a brutal financial negotiation. Assets you built together, debts you incurred, accounts you shared, they all become pieces on a chessboard in a high-stakes game where the rules are complex and the penalties for mistakes can haunt you for decades. You might be worried about losing the house, or getting a fair share of retirement savings, or being stuck with credit card debt you didn't even know about. This feeling of financial vulnerability is completely normal, but it's also dangerous if it leads to rushed decisions or paralysis. In this guide, we will move past the fear and provide a cold, clear, step-by-step financial action plan for navigating a divorce. This isn't about winning or getting revenge. It's about strategic self-protection and ensuring you emerge with a stable, sustainable financial foundation for your new life. We'll cover the immediate emergency steps, the meticulous documentation required, the team of professionals you need, and the insider strategies for negotiating a settlement that focuses on your long-term security, not just short-term emotions. The moment divorce becomes a consideration, you must shift into a mindset of financial defense and documentation. This is not about being adversarial, it's about being prudent. Step 1 is to secure your immediate financial oxygen. Open a new, individual checking and savings account at a bank where you do not currently have joint accounts. Start having your paycheck, if you have one, deposited there. Next, if you have joint credit cards, call the issuers and remove your spouse as an authorized user to prevent new charges, but be aware you are likely still liable for the existing balance. Do not cancel the cards outright, as this can hurt your credit score. If you are concerned about your spouse draining accounts, you can legally move up to half of the liquid marital funds from checking, savings into your new individual account. Document this transfer meticulously. It is crucial to leave the other half accessible. Changing passwords on your personal email and financial accounts is also a non-negotiable step. These actions aren't aggressive. They are standard protective measures to ensure you have access to funds and to prevent financial sabotage, which is unfortunately common. Now, you must become a forensic accountant of your own life. Your most powerful tool in divorce is information. You need to create a comprehensive inventory of assets and debts. Start with the easy documents, recent statements for all bank accounts, investment accounts, retirement accounts, 401ks, IRAs, pensions, and credit cards. Then move to the major assets. Get the deed and mortgage statement for the house, titles for vehicles, and statements for any other loan, student, personal, business. Don't forget the often overlooked assets, the cash value of life insurance policies, frequent flyer miles, memberships with equity like a country club, valuable collectibles, and even stock options or restricted stock units from employment. For debts, list every single one with the creditor, account number, balance, and whether it's in one name or both. A critical pro tip is to pull official credit reports for both yourself and, if possible, your spouse with their knowledge during a less contentious moment, as secretly pulling theirs may be illegal. This reveals all accounts in your name. You must also distinguish between marital property assets, debts acquired during the marriage, and separate property assets owned before the marriage or received as a gift on inheritance. Separate property usually remains with the original owner, but it can become commingled if mixed with marital funds, like using an inheritance to pay down a joint mortgage, which complicates things immensely. This inventory is not a one-time task. Keep updating it as you gather more information. With your personal documentation in order, you must now build your professional team. This is not a DIY project. At a minimum, you need a family law attorney who specializes in divorce, not a general practitioner. They understand state laws on equitable distribution or community property. But for any complexity of family business, significant assets, a high income disparity, or suspicion of hidden assets, you need a certified divorce financial analyst, CDFA, or a forensic accountant. A CDFA doesn't replace an attorney. They work alongside them to model the long-term tax and financial impact of different settlement proposals. For example, keeping the $500,000 house is not the same as getting $500,000 from a retirement account due to taxes, maintenance costs, and growth potential. A forensic accountant is essential if you suspect your spouse is underreporting income, common in cash businesses, or with bonuses or hiding assets in complex structures. The common, costly mistake is hiring the most aggressive pit bull attorney when a collaborative divorce or mediation process might be cheaper, faster, and less destructive, especially if children are involved. Your first consultation with any professional should assess which approach is right for your situation. The heart of the financial divorce is the settlement negotiation, which revolves around four pillars: asset division, debt division, spousal support, alimony, and child support. For asset division, the goal is a fair split, not necessarily 50-50. The key is understanding the true after-tax value of each asset. As mentioned, $100,000 in a traditional IRA is not the same as $100,000 in cash because the IRA will be taxed upon withdrawal. Transferring retirement accounts requires a specific court order called a Qualified Domestic Relations Order, QDRO. Mishandling this can trigger massive taxes and penalties. For the marital home, the options are: sell and split the proceeds. One spouse buys out the other's equity, which often requires refinancing to remove the other from the mortgage, or maintain joint ownership for a period, which is usually a terrible idea. Debt division is just as critical. The divorce decree can assign debt, but it doesn't remove your name from the contract with the creditor. If your ex is ordered to pay a joint credit card but defaults, the creditor can still come after you. The only way to truly be free of joint debt is to pay it off or have it refinanced into one person's name alone during the divorce process. Spousal and child support are separate from asset division. Spousal support is based on factors like the length of the marriage, income disparity, and each spouse's ability to become self-supporting. It is often taxable to the receiver and tax deductible for the payer, though tax laws have changed for newer divorces. Child support is a calculation based on state guidelines, considering both parents' incomes and the parenting time split. It is not taxable or deductible. The insider strategy during negotiations is to focus on your post-divorce budget. Build a realistic monthly budget for your new single life. This document will guide you more than anything. It will show you if keeping the house is sustainable on one income, or if you truly need spousal support to bridge an education gap. Never agree to a settlement based on emotion or a desire to just be done. A bad financial settlement is a curse that keeps on taking. Once a settlement is reached and incorporated into the final decree, the financial work is not over. You must implement the orders. This means actually transferring titles, changing beneficiaries on life insurance and retirement accounts, executing the QDRO, closing joint accounts, and establishing individual credit. You must also file a new Form W-4 with your employer to adjust tax withholding now that your filing status has changed. Create a new estate plan, a will, power of attorney, and healthcare directive to reflect your new circumstances. Finally, begin the work of rebuilding your financial identity as a single person, which may include building your own credit, increasing your income, and adjusting your long-term investment strategy. In conclusion, handling financial paperwork during a divorce is a process of methodical self-protection, meticulous documentation, and strategic negotiation guided by expert advice. It requires you to separate intense emotion from cold financial reality by taking immediate steps to secure your funds, creating a comprehensive asset and debt inventory, assembling a skilled professional team tailored to your case's complexity, and negotiating with a clear-eyed focus on your post-divorce budget and long-term security, you can navigate this difficult transition. The goal is not to emerge unscathed, that's impossible, but to emerge financially literate, stable, and in control of your next chapter. Disclaimer: I am not a lawyer, certified financial planner, or tax professional. The information in this video is for educational and informational purposes only. It is not legal, financial, or tax advice. Divorce laws vary significantly by state and are highly complex. The financial and tax implications of divorce are profound and long-lasting. You must consult with a qualified family law attorney and a financial professional such as a CDFA or CPA in your jurisdiction to advise you on your specific situation. Do not take any actions regarding asset division or support without professional counsel.